All right, is my audio good? You guys can hear me? Okay, great. So let's get started. Welcome everyone. We're going to do today a introduction to DeFi, and we're going to look at some key smart contracts. Actually, what we're going to look at is we're going to look at different categories of DeFi, and then we'll look at 2 or 3 different smart contracts, specifically MakerDAO, Compound, and Uniswap. It's hard to get into all the details. There's a lot of details. We would need probably an entire day, but we're going to try to get into a kind of a broad overview of DeFi, and then we'll kind of dig into a little bit of the details, specifically around what I would like to really cover is Uniswap, and the constant product formula and how that works. To a lot of people, it's a bit of a mystery. And so a lot of the information that I'm presenting today is going to be very, very basic. If you're already familiar with DeFi, it might be somewhat familiar. If you're absolutely new to DeFi, then this should be really, really good for you. But if you're familiar with DeFi and you're not familiar with how Uniswap works underneath, then or how MakerDAO works underneath, then this might be a good introduction to that. So so this will be kind of a broad introduction, but there'll be some areas where we're going to kind of go into some quantitative detail. Like I'm going to go into some of the formulas, and as much as I can squeeze in within an hour. Normally, I do a course on DeFi that can last a day, like 8 hours. So this is kind of more of an abbreviated version of that. So I'm going to get started. Just a few introductory things. One is, and this is really important, is here a standard disclaimer. Nothing here that I'm presenting here should be construed as investment advice, or that I'm advocating the buying or selling or trading or staking of anything. So everything here is just for information and educational purposes. Beyond that, there's nothing I'm going to be suggesting in regards to investing or anything like that. So please be aware of that. I also started a DeFi Discord, and this is a Discord for DeFi education. So if you want to learn more about DeFi, we're going to launch it in actually March, but if you want to get in now, it's open now. But we haven't made a wide marketing around the Discord yet, but we will soon. But if you like to get into a Discord where you can learn about DeFi and not get hammered for asking what people might think is a stupid question, then this is that Discord. And I'm running a DeFi conference March 3 to 5 called DeFi Con. If you guys want to learn more, I've got all the major protocols coming. I've got Compound. We've got Consensus. We've got people from DXDY, from Harvest, all coming. And we're signing up more and more people every day. This is basically going to be a educational lecture series. So they're going to come in and talk about how their compound works, how their protocol works. They're going to come in and talk about how yield farming works. And then they're going to move on, and we'll move on to the next lecture. So it's going to be kind of this back-to-back lecture series, and that you can come in and learn. Right. So if you want to register for this now, go to DeFi, that's with 2 I's, con.com, and there's a registration link, and we'll send out the invite link for that early March. So please be sure to sign up for this. A little bit about me. I run a company called Chain House. I'm based in New York City, and actually we're just expanding to Asia now. I'm also a professor, an adjunct professor at Columbia Business School, where I teach blockchain. Also at NYU and CUNY, I teach both business side and technical, like coding, machine learning, blockchain, and AI. I just came out with a book from O'Reilly called Mastering Corda. Came out in November. It was an Amazon bestseller. It still is. I think now it's top 50. And I have an MBA from Columbia. I'm actually doing my second master's at Georgia Tech in AI. So I'm not only am I teaching, I'm also learning and running a company. And that's my kind of bio. If you guys want to contact me, you just go to jamiel.io, and I've got information there. I also run a very large blockchain meetup group in New York City. We're, I think, past 6,000 people now. And before COVID, we were doing lots of events, about 30 events a year or so. That's actually how I met Anna, who graciously invited me to come and speak here. We do, now we're doing events online, but once we get back to some degree of normality, we're going to go back to doing events in person, and we'll get a lot more information around DeFi during these events. I kind of really look forward to that. Okay, so now the topics I'm going to kind of cover today. I'm going to go over quickly what DeFi is, and then talk about some of the earlier use cases of DeFi, which are like tokens and SDOs and ICOs, and people may have heard of it, and then asset tokenization, and then all this new stuff that's kind of emerging. So kind of we're going to rewind back a little bit, say, well, these are the things that occurred the past couple of years. You can consider them under the fold of DeFi. And then all of a sudden, all this new growth that's occurring, especially the past 12 months, and kind of look at what they are, like money markets, exchanges, prediction markets, oracles. And then we'll look at, some of the risks that are occurring in the space and some of the tools that you can use if you want to learn more. And we'll go into Q&A. Anytime you feel like asking a question, just, pop it into the chat. I suggest that we kind of keep questions towards the end. I'm going to try to skip over a couple of these slides just while monitoring the time, so that we can kind of like focus on more of the juicier stuff, and kind of skip some of the stuff that might be a little bit more people might be more familiar with. I don't know where everybody's at. I don't know what the audience is at, so I can't make too many assumptions about everybody. So just tell me by your questions where you feel like we should kind of concentrate more on. Okay, so let me get started. So quick overview, what is DeFi? It stands for decentralized finance. Whenever I teach, I like to start off with the very, very basics. I can't make assumptions about people. And this is in contrast to CeFi, which is centralized finance, or which is what traditional finance is, right? Finance today is centralized. And we experienced that pretty heavily this week because we saw what happened with Robinhood and stocks like GameStop, where Robinhood came in and said you can no longer buy GameStop stocks or equity anymore, and whatever the reason was, whether the reason was justified or unjustified, the point is that some authority had the ability to come and tell you you can't buy or sell something in what supposedly a free market. Right. And so the idea in the decentralized finance is, well, such things should not be possible. An arbitrary decision by an authority to come in and say you can't or can do this should not be possible. That the rules of how finance work are embedded in code. Right. And so that you can see the code is open source and it's transparent. You can see the rules of the game, so to speak, and that you interact with a blockchain and you're doing your financial transactions through these smart contracts, and you know the rules of the game. Now, that doesn't mean that there won't be shenanigans and all that. There still can be, but at least you can kind of compute and assess more openly what your risks are. Right. And because these applications are programmatically created, these economic models are programmatically created. I can create a money market by coding that money market. I can create a money market by deploying that code onto a blockchain, and all of a sudden I have a money market similar to what a bank has when they sell you CDs, or the Treasury has when it sells you T-bills. It now has spurred the ability to create all kinds of innovative and creative new economic models. Anything that I can think of, as long as has justified economic principles, there's supply and demand, equations that make sense. If I can create that in my mind, I can then probably create it in code, and I can deploy it, and I can make it real, right? So I can realize ideas that I have about how finance should work and implement it immediately, right? Probably within a day or 2 days, 3 days, depending on if I have the coding capability, and get it out into the market and potentially test it and see if it's successful or if it's a failure, right? Because of that, DeFi is probably one of the more complex and intricate areas of blockchain. So blockchain itself is fairly complex in how it works for most people, especially if they're not a technologist. But then if you bring in DeFi, it adds a magnitude of complexity. And we'll experience some of that complexity today, right? We'll see some of that kind of complexity, but that complexity creates a lot of power. And that is one of the driving forces behind DeFi, that not only is it decentralized, but it's extremely creative, right? And that doesn't get the most of the attention, but that's where the attention should be. It shouldn't be that it's decentralized. That's almost a given now, but where the power is that I can create and design my own economic models that I engineer on my own. I can sit down and take a piece of paper and engineer an economic model and work out the principles of it and then convert it to code and deploy it. And boom, I can start trading with people. I can start interacting financially with other people, and the rules of the game are defined in that smart contract. So for me, that's very exciting. That is kind of a major realization of what blockchain is and what blockchain should be. It's not just Bitcoin, but now all of a sudden DeFi is taking us way, way beyond the vision of Satoshi. So why should I care about DeFi? Obviously, if you're here, you do care to some degree. But if you have friends and you say DeFi to them and they're like, I don't know, I don't care. Here are some of the reasons you can tell them why they should care. Number one, DeFi is something that's global, right? So it's not that it's a local market. It's not the New York Stock Exchange. It's not NASD that's only dealing with U.S. equities, and then you can't have access to Chinese stocks, and you can't go to Europe and get access to Swiss stocks. You got to go through all these processes to open up an account at a Swiss brokerage. Here, the minute you deploy a smart contract, that financial and economic model is accessible globally, right? So some kid in Vietnam can also start trading. The minute you deploy that smart contract, they can start trading, and anybody in the world can start trading as long as they have internet access. Theoretically, also settlement is rapid, right? So the minute you trade, within a block or 2 blocks of consensus, that the trade settles. It's not like the U.S. equities where it's T+2, where I've got to settle in 2 days. And actually, that's one of the reasons Robinhood had to, or they're claiming they had to limit their allowing their customers to buy GameStop, because they had to put up money with their clearing firm, and that 2-day window meant that they had to cover that money, and they couldn't use customer money for that. So that kind of is different with DeFi. Settlement time is within a block or 2 blocks. You earn interest potentially if you put crypto and you're generating interest income on that. You're earning it per block, right? Not per quarter or per day or it's per block. So it's more frequent increments, right? And then we can do things at a fractional level, right? So I can potentially invest 1/100 millionth of a penny. If I wanted to invest that small amount, I can potentially theoretically invest that small amount, or I can pay that small amount of interest. And I'm not saying that you should, or not that it's the way to do it, but it's possible, right? Whereas right now in traditional finance, you can't do that. And there's theoretically lower friction. There's a lot less things in the way. There's a lot less paperwork I've got to fill out. I don't have to worry about getting approval. I don't have to worry about going to a bank and knowing the bank manager and the loan manager and being on their good side and all that kind of stuff. And the market is always open, right? So you can trade at 3 o'clock in the morning and get up and start trading and getting involved. It's not that the market closes and you're not going to get jumped and surprised when the market opens and there's a sudden fluctuation in price and you get caught by that. The market is always open. So over the long run, like the FX market, over the long run, this is going to reduce volatility, not increase volatility. Over the long run, that theoretically will reduce volatility because information that changes prices will be more evenly spaced out over time. the arrival of that information and the impact of that information on price shocks will be more evenly spaced out over time than all kind of combined in and impacting the market at 9:30 in the morning when the market's open, and then boom, all of the price shock occurs at once. These are some of the reasons why DeFi matters, and where we're trending is that DeFi, I believe, in 10 years will be the norm of how you do DeFi. Now, there are some challenges, and we'll talk about some of that, but that's going to be, I believe, in 10 years from now, is how everybody does finance, or a good portion of how they do finance will be what we call today DeFi. I don't know what it will be called in 10 years from now, but today we call it DeFi. This is going to morph and manifest in different ways. It's going to challenge governments. It's going to change how people do things. It's going to go through some setbacks. It's going to go through growth spurts like it is right now. We're going to see regulation come in. We're going to see all kinds of people get scared about this. Actually, we saw a member of the Bank of England say, I think it was yesterday, that cryptocurrencies will be gone in a few years. So I don't think that's the case, but you can see that it's creating some friction with authorities, and we'll see how this pans out. But I believe in 10 years, will be how will be the norm. And most importantly, as far as my personal, it's going to be accessible to the unbanked. So you have hundreds of millions of people globally that don't have access to banks. Never mind that they're not accredited investors and cannot get involved in these investment opportunities that are only for a certain segment of society. But with DeFi, and as long as somebody has access to a simple computer, even if it's for an hour a day, if they have access to a phone, they can get involved and make money and potentially build a business. And so I think that's incredibly important and exciting about DeFi, which is significantly different than centralized finance, where if you want to trade, you need to open a brokerage account. You have to go through a bunch of hoops. Some of them are good, like KYC, AML, they're good. But then so many people have been disenfranchised because of a lot of these rules and a lot of the accessibility. I need to be able to get to a branch. And if I'm sitting in a remote village and live in a remote village, it's going to be harder to get to a branch. Therefore, I am not going to be cared for by the bank. The bank's not going to see me as the market, and I will never then therefore be educated by the bank around what my product options are. So this is some of the reasons why DeFi is going to be important. And if you're talking to your friends about the importance of DeFi, those are some of the major points I would bring up. How do we get here? I'm going to quickly turn back. Everybody's kind of familiar with Bitcoin. We've solved major fundamental problems with Bitcoin. We solved double spend, right? And we think that's a simple thing now. We've kind of taken it for granted. But 10 years ago, it was a massive problem, right? How you solve double spend, we've kind of solved it. To some degree, we've solved decentralization, even though that's debatable in a lot of spaces. I'm not going to get into that debate. But blockchain is fundamentally not technology. It's fundamentally an economic system. It's a blackboard or a chalkboard where I can start creating whatever I need to create. And that blackboard and chalkboard is an economic system itself. It's an economic foundation. It gives me the ability to create economics on top of it, right? That's what blockchain is. It's an economic platform. Now that we have this economic platform, whether it's Bitcoin or Ethereum or any other chain, I can build all of these other things on top of it, right? So Bitcoin got us into the door, and it's getting us through a lot of this stuff. It's leading kind of the way in that kind of vision and that kind of thought leadership. But Satoshi's not around, and yet Bitcoin is the preeminent crypto. That indicates that the personalities are not important. That the thought leadership around the person is not important. It's that the vision and the ideas are more important, and therefore the ideas are now out of the bag. Like the cat is out of the bag, and so Bitcoin has basically put the cat out of the bag for us, right? The problem with Bitcoin was not that it has a problem, it's that there are certain limitations with Bitcoin, is that it does only one thing. You can only trade Bitcoins on the Bitcoin blockchain. You can't do much else, right? That's because it has a rigid data structure in its ledger, and that data structure is from to the amount, so to speak, and all you can do is put entries that fit that data structure, right? effectively transactions between two parties, right? So if I want to send Anna Bitcoins, I can send her Bitcoins, and there's a data structure on the Bitcoin blockchain that records that transaction. But the Bitcoin blockchain cannot record anything more complex than that data structure, right? So if there is a credit default swap that Anna and I are getting into, that information cannot be stored on a Bitcoin blockchain because that data structure is too rigid. So, well, I don't have the fields for you to put that information in, so therefore we can't store that kind of trade, right? So, and we call that kind of non-Turing, sorry, not Turing, but non-Turing, like from Alan Turing, non-Turing complete. Has some kind of scripting, but very limited in what it could do. And then Ethereum came along and allows us to build more robust. We can define our own data structures. If I want to define a structure that has these type of fields in it, I can just define it, and then I can define behavior right around that structure. I want to be able to do this with this structure. I want to be able to add this to that field. I want to subtract it. I want to create inventory around this and that, and that's what we call smart contracts. We're kind of coupling data structure, customized data structure with behavior, and now I can just deploy that on a blockchain, and potentially anybody can invoke that and has access to that, right? That changed everything, right? Once you were able to do that, that changed everything. That ushered in the idea of ICOs. And what is an ICO? It's effectively a data structure on Ethereum. It's just an allocation table, right? You've got people who are on the Ethereum who have accounts on the Ethereum blockchain, or addresses or accounts, similar to a bank account, like similar to how you have a bank account number. And they're allocated an arbitrary number next to it called tokens. So we just happen to call them tokens, but it's just an arbitrary number. And if you want that number in your associated with your address to increase, you buy into it, you pay Ether in, and you increase the number in that allocation table for your address, right? And that's basically how crowdfunding on Ethereum, which we call ICOs, got started. It was basically a core data structure, an allocation table. Column one was the address of the people that wanted to put money in, and column two was basically a token and how much money they put in divided by how much each token costs, right? And so by keeping this allocation table, I was able to offer raise capital, and what I promised in return for raising that capital. We know now a lot of cases was dubious, right? So there's all these projects, and I'm going to give, I'm going to do this, I'm going to do that. So people put money in. There was no collateral involved. There was no way for me to redeem anything. No way for me to say, hey, I bought equity, and therefore I can go after the balance sheet. If the company's not going to survive, I can go after the assets. But that didn't occur in the ICO world. You were just buying in on hope, right? But the point is that these smart contracts allow me to create an allocation table, which is a key value pair, and raise capital by changing the values in the allocation table, right? And that effectively became how ICOs were done. And then, that caught up, the illegality of all of these things, it caught up. And, we know now about 90% of these ICOs were problematic. I don't want to say fraudulent, but that is probably an appropriate word. And, we have these headline cases like the SEC suing Kick and all of that, right? And you have blockchains like EOS that raise phenomenal amounts of money and are spending. And then there's a kind of a bust period, right? So 2018, 2019, it was kind of like 2018, like we just basically ICOs started to dwindle, and then they morphed into what's called STOs, right? Security token offering, basically an ICO, but a regulated ICO that's following the SEC mandated policies and procedures. And that kind of market kind of cooled off. The ICO market kind of cooled off, but it will come back. It still exists, and if you go to stomarket.com, you'll see like these issuances. But it also opened up the Pandora's box around DeFi. It's like, well, I can do all these different things and create other data structures. I don't have to just do an allocation table. I can do all kinds of things as well. And so then this idea of tokenization came out and said, well, maybe I don't have to not have a collateral underneath. Maybe I can put some kind of collateral and issue tokens against that collateral. It could be gold, it could be oil, it could be real estate. All these companies came up and say, well, I'm going to take this asset. It's not a project anymore. It's an asset that you can see it, and I can put it with a custodian, and I can issue tokens against it. And now there is the token has value, right? There's value that you can redeem, and that value is identifiable to possibly something physical. In the case of there's like crypto kitties, there's virtual cats that you can buy and sell, but I can associate tokens to something that I can kind of relate to and kind of track and see and things like that. And that kind of emerged and had its place and still has its place in the market. But we can consider this the early stages of DeFi, right? People are like figuring this out. Solidity coders and developers and blockchain developers are figuring out they're cutting their teeth on this kind of stuff. They're learning from mistakes. Some of these projects are doing well. A lot of them are not doing well. But it was the precursor to like where we're at today. And today's we're a precursor to where we're going to be going a year from now. And we'll see where that happens. But each time we move forward, we're getting the blockchain and DeFi thing is getting more and more resilient and stronger. And we're learning from the mistakes of the past. And we're becoming, even as we're becoming more and more resilient, we're becoming more and more complex and more comprehensive and more thorough, as we'll start to see in some of these examples that we go into. Right. So typical tokenization layout. There's, you've got your issuer that places an asset with a custodian and then issues tokens against that asset. And the token holder, like me or you, would then go in and buy tokens from the issuer, right? And then you can go off and trade those tokens on an exchange, right? Basically, general. This is kind of like a approach taken the past couple of years. There's a bunch of platforms out there that do that: Polymath, Harbor, T0, and there's a bunch more. They manage documents. The problem they have is liquidity, right? And you're going to see that this is what a lot of DeFi focuses on right now. It's front and central in terms of the focus of DeFi is how do I create liquidity immediately, right? And so beforehand, the problem we had is with the asset tokenization and ICOs is great. I can sell the tokens, but now that I've bought a token, I'm a buyer. How do I offload the token if I want to get rid of the token? And liquidity was a problem. I had to hope that that token got listed on an exchange, and maybe there was some liquidity there, but that was a big bet. And big part of DeFi now is, and you see these protocols, the thing that they focus on, or one of their major focus is on creating liquidity immediately, potentially seeding that liquidity and allowing that liquidity to grow, right? And so even while you're trading, you have the assurance that there is some liquidity there. Now, nobody's guaranteeing any liquidity. We've seen DeFi protocols have an enormous amount of liquidity within a day, start from zero liquidity to have an enormous amount of liquidity, then within 2 days have zero liquidity, just go up and down and get thrashed around. But we can learn from that as well, right? So, and then we've got these tokenization platforms that are doing real estate. At the same time, there's this now demand for stability around cryptos, right? So, hey, cryptos is very, very unstable. These ICO tokens are not stable. Bitcoin, which has failed in the sense that it's a currency, it's not a currency, right? So one of the problems is we need a currency to have stable value, right? So even though Bitcoin is a store of value, that store of value is not predictable, right? And because it's not predictable, it cannot be currency. If I take $1 today and buy a gallon of milk, and tomorrow I can't buy that gallon of milk, but then the day after I can take that $1 and buy a Lamborghini, then my ability to rely on that $1 and how I behave with that $1, how I treat that $1 is going to change. I'm going to save it. I'm going to stuff it. I might not eat. I'm going to hold on to that dollar because I'm like, let me hold on to that dollar for another 2 more days and starve myself so that I can get that Lamborghini once it goes up. Our behavior changes significantly if our psychological trust in that dollar's value is not predictable. And if I can't predict the value of that $1 and what it will buy me, what its purchasing power is in a day or 2 days or 3 days or a month, then my behavior around holding that $1 will change. So in that sense, Bitcoin, I would not say it's a currency because nobody is buying Bitcoin to buy milk, right? Nobody's buying Bitcoin to do that. They're buying Bitcoin to sell it to somebody else at a higher price. And that's the only reason you would buy Bitcoin at this stage. You're not buying it to buy pizza. So because of that, the volatility around it is significant. If you look at some of the volatility numbers, this is standard deviations. This is not price. This is the volatility of Bitcoin in standard deviation. Same thing for Ethereum. The volatility in standard deviation is pretty high, right? So 12 standard deviations in volatility is astronomically high, right? So if you're in equities and trading equities, if you're trading 2 or 3 standard deviations away, you're considered a cowboy, right? You're trading significantly risky stuff. And here's Ethereum hitting 10, 12 standard deviations in terms of its volatility, which is significant, right? So that created this need for stability, right? You have all this volatility. There's a desire for crypto stabilities, and that caused the emergence of what's called stable coins. Basically, I have a token. It's just a token, and I need some way for that token to equal some value that is constant, whether it's $1 or something else. I need to bring stability to that token's value. And there's many ways to do it. I can peg it against an asset. I can take a token and promise you, say, hey, if you buy this token and you ever give me that token back, I promise to give you $1 back. As long as it's redeemable to $1, that token's value is pretty much going to stay around $1, right? And so these stable coins emerge. There are different kind of strategies around how these stable coins manage their value. So if I got $100 million, I put that into a pool of like into a vault, and then I issue 100 million tokens. The theory is that those 100 million tokens, each one of them would be worth $1 as long as I made it redeemable, right? So if you gave me that token back and I issued it to you, but you gave it back to me, I'm like, I take $1 out of that vault and give you the $1. And if somebody wanted to buy that token, they give me $1 and I give them the token. And theoretically, that token's value would be $1. And so there was fiat collateral. I put $100 million into a war chest and then issue tokens. There's asset collateral. I can put $100 million worth of gold and issue tokens against that. This crypto collateral, I can take $100 million worth of Bitcoin and, or something else and issue tokens against that. But what's really emerging now is algorithmic stablecoins or computational stablecoins. We'll look at one of them, like MakerDAO, that has that kind of capabilities, right? Where there is no underlying asset. It's just the math in smart contracts that work in supply and demand economics that work to stabilize the price of that token and keeping it not at $1, but around $1, right? And that's some form of stability. Okay, so let me just go through. Let me skip some of these slides. Tether is an example of a fiat stablecoin. There's a bunch of them. USDC by Coinbase. Now the decentralized stablecoins are now coming of age, right? The major one is MakerDAO. I actually personally am working on a algorithmic stablecoin myself right now called Universal Basic Coin. Hopefully it'll be out in 2 months, just an experiment. And if you guys want to work with me on that, please hit me up. And this stablecoin MakerDAO is basically a 2-token system. You have what's called a DAI, which is the actual stablecoin, which is worth around $1, right? And then there's another token, which is the governance token, and it's used to pay interest. So you can use stablecoin, you can borrow and lend the DAI. And a Maker is how you would pay the interest back. And Maker, if you own Maker tokens, it's like voting rights around the governance of how MakerDAO works overall, right? So kind of briefly how MakerDAO works. There's a there's a bunch of MakerDAO smart contracts, but conceptually here, like we're looking at the slides here, conceptually here, you put in money with MakerDAO, you have to over collateralize. So let's say you put in $300 worth of ETH into your MakerDAO, you're going to get back to about $200 worth of what's called DAI, and that DAI is of stable value. Even though the value of ETH may go up and down, the value of the DAI is stable, right? So there's some economics behind it. I'm going to go over it briefly. So like, why would you give up $300 worth of Ethereum to get $200 worth of DAI? You haven't lost that $300 worth of Ethereum at all. Some people do not want to give up that Ethereum. Like, well, I want to hold on to it. I don't want to sell it. But at the same time, I need some liquidity. Companies that might be paying employees might not want Ethereum. They can go off and get DAI and pay maybe in DAIs and dollars and convert the DAI to dollars, right? And just some stability around that, right? So if I want a stable coin, I can like put ETH into the MakerDAO contract and get back DAI, and it's collateralized. The DAI is minted at the time that I submit the ETH. When I submit that ETH into the contract, DAI is minted, so the supply increases, the DAI supply increases, and I am going to pay an interest rate for taking on that DAI. That's known as the stability fee. And I pay that interest rate. I'm trying to get my mouse here. I pay that interest rate in Maker token. So when I pay back and try to get my collateral back out, I've got to pay back the DAI, and I pay back interest, but that interest is in the Maker token, which creates another supply and demand a market for the Maker tokens, right? There's another supply and demand dynamics for the Maker token. I'm explaining to you the supply and demand mechanics for the DAI token. The DAI tokens originate or are created once I put ETH in, right? If I return my DAI, the DAI is burned. And so that's how we remove supply, right? So that's how it impacts the valuation of the DAI, right? So if the value of the DAI starts to increase against the dollar, let's say the value of a DAI starts to become less than $1, and here's a chart of how much the DAI is worth. We can see that at times it exceeds $1, a little bit like $1.05, but by and large, it's hovering around $1. If the price of DAI becomes less than $1, that means the collateral that it represents, that's sitting in the ether that's sitting, is cheaper, right? So it's like saying that I bought a house for $100,000, right? And now the dollar is worth half of what it's worth. That house is now worth twice as much, right? It's worth $200,000. So what's going to happen is there's going to be a desire to go in and buy more of that out, and which will then bring back the price of DAI back up, right? The demand would bring back the price of DAI up. And conversely, if the DAI exceeds $1 in price, that means the collateral is more expensive, and people will sell off the DAI, right? And burn off, create more DAI, and that will reduce the price of DAI back to $1. So that's kind of economic dynamic of like increasing the value of DAI versus the underlying assets that it represents, and increasing the supply and demand accordingly will move the price of DAI and keep it around $1. Okay. So, but there's more details. I don't want to get too much into details. There's 2 more protocols I want to kind of cover. But we can get into more details on MakerDAO probably in another session. So, and then the Maker tokens, they're incentivized to keep the system stable as long as people are transacting. They're using Maker tokens. Maker tokens are burnt. That means the value of Maker tokens are going to continue to increase as the supply of Maker tokens decreases. That incentivizes the governance, people with the Maker tokens, to make the right governance decisions in order for the Maker tokens to continue to be burned. As they're burned, and the demand for that token stays the same, the value of that token will move up, right? And that's kind of the general theory around that. So each of these 2 tokens within MakerDAO, they have their own economic model, but then they have an economic model that ties them together based on supply and demand economics that allow them to like cooperate and work with each other. And so the DAI token serves its purpose of trying to maintain stability around $1, and the Maker token incentivizes good governance decisions. Like example of governance decisions is like, how much should that interest rate be that we charge people that are going to take DAI out? Those kind of decisions. If the interest rate is too high, then people are not going to take DAI out, and the value of Maker is not going to increase, right? The Maker token. And so they're incentivizing good governance of the MakerDAO metrics and parameters like stability fee, interest fee, and things like that. Okay, that's a kind of a quick overview of, and this is an example of some of the smart contracts that are working together. So it's fairly an elaborate thing. Now, what we have emerging in DeFi, and this is a major part of DeFi, is the notion of money markets, right? And if you're familiar with opening a bank account, you pretty much have a money market. You buy a CD or you're in an interest-bearing account. You are involved in a money market, and money market is basically a market of borrowers and lenders, right? So hey, I've got an asset, I want to lend it out, or hey, I need to do something, I need to go borrow some money, I need to buy a car, I need to buy a house. I've got excess cash, I'm going to deposit it, right? And in the DeFi world, there's slightly different terms that are used. So a liquidity provider is somebody who's going to provide cryptos and say, hey, here is cryptos that I can give to you. You can consider somebody like a depositor. He's going to deposit, or she's going to deposit stuff. They're providing liquidity. And then you have borrowers, right? And then you have some similar bank terms like APY, the yield, right? So if I'm going to borrow or if I'm going to lend, what's going to be my return on investment? What's going to be my yield that's going to be I'm going to be able to make? What's interesting to note is in some cases, borrowers can actually make money. They actually can earn interest and make money on borrowing, and which is kind of wild. And we'll see some of that in a bit. About 20 minutes, right? How are we doing on time, Anna? Are we okay? So let me just take a sip here. Okay. 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 So there's a bunch of platforms that are doing these money markets. Compound is one of the bigger ones. Aave, Dharma. There's a bunch of them. There's also Celsius, but they're centralized. But I think the last number I had with them is that they had about $3-4 billion, $5 billion that they're managing in cryptos, right? In the money market that they've created. So the demand for this kind of stuff is significant. Basically, with Compound, a lender parks, and a lender is also, so in order for you to borrow, you have to be a lender, right? So you can only borrow if you lend, right? And so if I wanted to borrow DAI, I can lend ETH, right? So I would lend in, ETH, and I would borrow DAI. I would put it into a contract, and then I would get a yield, and I would also get what's called, in the case of Compound, as a borrower, I would get also Compound tokens. All right, and those tokens have valuations themselves. So if I go to compound.finance, I can see the money market here. If I'm going to lend, I can lend at these rates here, right? And if I'm going to borrow, I can borrow at different rates here, right? Obviously, you'll see the borrowing is more expensive than lending. And when you borrow, the interesting with Compound is when you borrow, you also get not only the token that you borrowed, but you also get comp tokens, which have its own market rate, which can potentially mean that as a borrower, you can actually make more money. You can make money on the money that you borrowed, which is kind of wild. So if you look at the growth rate in lending, I've got some more charts. You can see that lending has increased significantly, especially over the past 12 months. I think total locked in DeFi right now totally is about $30 billion. And this was maybe 1/10 of that a year ago, right? So the growth is significant, right? So that's kind of Compound. Let me just kind of skip to, this is the comp token that you get as a borrower. So the token has its own market rate. And these are some tools that you can use to see if you were to supply and borrow a certain type of token, how much you could potentially make. Okay, and there's calculators out there that can do that for you. Okay, now this has led to this kind of notion of yield farming. Yield farming is the idea that I have Ether, I've got tokens, I'm going to try to park it and shift and search and move around and find different protocols that I can park and make and maximize my APY. Like, okay, I've got Ether, I'm going to park it with MakerDAO. I'm going to pull out these DAI, and I'm going to take these DAI, I'm going to put it into Compound. I'm going to do all these different hops. And yield farming is basically now the strategy of like, how can I do that and best maximize my APY? And so we see tools now coming out that help you with yield farming. An example of one of them is Yearn Finance. You can go out there and it'll help you maximize your APY and find ways to move your money. So there are people that are like they're parking their tokens and they're borrowing tokens, and then they're taking that tokens and they're parking it back in again, and they're cycling it back and forth. And so all these different strategies are involved, and there are tools that help you kind of do that, right? So this kind of yield farming, and there's a bunch of terms around, related to how to do that, like crop rotation and things like that. I'm not going to get into that here, but yield farming is becoming a major way of doing DeFi as a user of DeFi. And this is worth exploring. The other major use case, we can call them exchanges, right? And we've got maybe about 10 minutes here. Exchanges is basically the idea of you're swapping things. So like when you buy equities in a market, you go buy a stock, you buy GameStop, you're basically swapping. It's like, here's dollars, give me stocks in whatever company, right? And it's basically a swap, right? And so these exchanges allow you to do swaps. There's a bunch of different types of exchanges, right? There's centralized exchanges, Coinbase, Gemini, and then there's decentralized exchanges. What was big a year ago, 2 years ago, were like the 0x DEX, the decentralized exchanges that were based on 0x. But what has emerged now is other kinds of decentralized exchanges that are not based on 0x protocol. They are just pure smart contract based, and they just work completely on the Ethereum chain. There is no nodes or relays or other kinds of things. So what I'm going to do is I'm going to skip over the 0x, talking about 0x. I'm going to jump to talking about how Uniswap works, or like one aspect of how Uniswap works. But quickly, a DEX is basically a bunch of computer nodes, a bunch of nodes communicating with each other. These are decentralized mini exchanges that have what's called makers and takers. Basically, market makers say, I'm willing to buy and I'm willing to sell. They're called makers and takers, and they communicate with other nodes, and it's called relay. So there's off-chain search. I'm running a 0x node. I've got a bunch of makers and takers on my node who are willing to buy and sell basic different tokens at different prices, and I'm connecting to other relays and saying, hey, do you have a maker or taker that matches up with a maker or taker in my node? And if we do, then the settlement and trade occurs on chain, right? And so we see a lot of that occurring, but that market has not really taken off. The 0x has not really taken off to the extent that we see with exchanges like Uniswap. So I'm just going to jump over to Uniswap here. Okay, and I've got some Python code if anybody wants to, like, they go to how and hits 0x exchanges, and anybody wants to kind of see that the limit order book on any specific 0x exchange, like or relay, like Radar Relay. But Uniswap is big now. Like there's a lot of activity occurring in Uniswap, and so in Uniswap there's two functions that you can perform. You can provide liquidity, like add or remove liquidity. So you're coming in and giving liquidity, and you're taking away liquidity, or you can trade, right? You're basically swapping. Say, here's one token, give me this other token, right? And that's it. So those are the two main functions that you can do in Uniswap, right? We're going to look at a major component. This is actually, I think this is a paper written by Vitalik Buterin on constant product formula, and we're going to see how Uniswap uses constant product formula. And there's something called divergence, where actually when you put money in, you actually immediately lose money in Uniswap, but you can recoup that in other ways, and I'm going to show you how that works with Uniswap. That's why it's important for you, if you're going to trade and play with Uniswap, to understand the economic model behind it. I'm going to kind of give you a quick introduction here on how that kind of works, and I think we'll probably shift to some questions if we have any questions, because we've got about 9 minutes. Okay, so the way that Uniswap works is I send Ether to a Uniswap smart contract. There's a liquidity pool, for example, for Ether DAI. They come in pairs, right? So there's Ether DAI liquidity pool. I send in Ether, I get back DAI, right? And I am a liquidity provider. At the same time, on the other side, they're traders. They're willing to like put in ETH and receive DAI, right? Sorry, the liquidity provider puts in two tokens. They put in both ETH and DAI, and they earn something. I'll explain to you what they earn. So I'm a liquidity provider. I've got extra assets. I want to deposit, right? Quote unquote deposit. So I take ETH and DAI and I park it into Uniswap, the liquidity pool that's specific to that pair. And on the other side, there are traders that are switching back and forth between ETH and DAI, or they're like, hey, I want here's DAI, give me ETH, or here's ETH, give me DAI, and they're trading back and forth. I am providing that liquidity for the trader to be able to do that. Okay, and so I'm a liquidity provider in this scenario. And let's take it for example, ETH is at $100 and DAI is at $1. It's a stable coin, so it's at $1. So what I would do is I would submit both that the ETH, and I would submit both the DAI into the Uniswap smart contract. So let's say the Uniswap contract already has in inventory 99 ETH. It has 9,900 DAI that already exists in the liquidity pool, and I'm going to come in and I'm going to put something in as well. So I put in equivalent amounts. I've got to put in 1 ETH, and let's say 1 ETH is $100. Therefore, I need to put in 100 DAI. Right, so the two have to be equal. They have to be equal amounts. And so I put both of them into the Uniswap smart contract, and now I'm a liquidity provider. And what happens now is the inventory goes from 99 ETH and 9,900 DAI to 100 ETH and 10,000 DAI. Right, and I've just increased the inventory. Because I've increased the inventory, the Uniswap contract calculates what's called a constant product formula, or a constant product, using the constant product formula. The constant product is a number that I'm going to use later that will tell me how much I can pull back out as a liquidity provider. And this is a little bit different from how trading works, right? But this is kind of the innovation, right? This allows what we call automated market making. Now, just by providing liquidity, I've become a market maker. The algorithm, this constant product formula, is adjusting what I can do or can't do as a market maker in terms of my ability to put stuff in and take stuff out of that liquidity pool. All right. So that formula is, you can consider it a form of automated market making. And that's the big innovation here. These contracts automate market making. Whereas like in the 0x exchange, I needed takers and makers, which were humans, or maybe they were bots or they were scripts, but I needed individuals to say, hey, I'm willing to buy and sell at certain prices. And they sit there with their store window open, waiting for customers to come in. In this situation here, algorithms are taking care of that, right? And so I don't even have to worry about whether a trader is going to come hit my bid or hit my ask. All I have to do is park liquidity. And whatever happens with the traders, they're trading my liquidity or not, I don't really care, right? I'm going to earn fees and things are trading, and I don't really care. So it bifurcated the liquidity requirements with what the traders do, right? It kind of bifurcated that and separated it out. So before I put my 1 ETH here and the 9,900 DAI in, right, I compute the constant product formula, which basically is the quantity of one pair versus the quantity of the other pair. And constant product here is 980,100, an arbitrary number, right? And we'll see how this number is used, right? Now, if I put in 1 ETH and 100 DAI, I'm going to go in as a liquidity provider. I put that in. After that, after I make that deposit, so to speak, I effectively own 1% of the liquidity pool, because out of that 100 ETH that's in the pool now, 1 ETH is mine, right? And 1,000 out of that 1,000 DAI that's now in that liquidity pool, 100 of those DAI are mine, right? So I own 1% of that liquidity pool, right? And my constant product is recomputed, so it becomes 100 times 1,000, which is now the constant product is 1,000,000. Okay. And so now that I have it at 1,000,000, if I want to withdraw, I can withdraw as long as whatever I withdraw maintains the constant product. And I'm going to explain what that means, right? So this is the key point in Uniswap. This is very, very important to understand, right? If you can understand this, then the rest is just trivial when it comes to Uniswap, right? So I'm in the situation where, imagine the price of ETH goes to $120, right? So it was at 100. I put a deposit of 1 ETH and 100 DAI. It goes to $120, right? Now what happens to my liquidity pool? I can withdraw 1% of that liquidity pool as long as I don't change the constant product. So I have to find two numbers of ETH and DAI such that multiplying those two numbers equals 1 million. Okay. And if I do that with ETH being at worth 120 DAI, if I do that, I find that these are the two numbers I compute. And I have a spreadsheet which goes through these computations. If you like, just email me or I'll give it to Anna. I'll post it on our DeFi Discord, which goes into step by step that kind of break down the calculations. If I go to, I'm just trying to look at getting my time here. Yeah. If I compute and I figure out what are the two factors that allow me to equal 1 million, which is my constant product, that's why we call it constant product, because I cannot change it when I'm withdrawing liquidity. That constant product must remain constant, right? And so I have to find the two factors that allow it to be constant, and those two factors are 91.28 ETH and 109 DAI. So when I withdraw, so the price of ETH moves up to 120, and I want to withdraw at that point, I will withdraw such that I maintain the constant factor at 1 million, because that's the constant factor. It was at this point, like a second before. I have to maintain the constant factor, and so I pull out that much. And if you calculate that, I pull out $219.09. Right. So I put in $100 in ETH, and I put in $10 in DAI, right? If I hodled it, my value would have been 220, but I put it in and I pulled it out of a Uniswap smart contract. My value is 219.09. So I lost a few cents on it. And this is known as divergence risk. Right? There's different terms and older terms that are used, but the correct term now is divergence risk. If my price changes of my like the ETH, if the price changes, here's an example of the price changes, like from P0 to P1, right? This is how much I lose. The only time I don't lose is if the price of ETH doesn't change. So if I put in $100 of ETH, ETH is like at $100, I put in 1 ETH, and I pull out at ETH equaling $100, I pull out, then I incur no divergence loss. But if I do that if there is a price change in ETH, whether ETH moves up or down, right, I lose in my Uniswap contracts. And then the question is like, why would I? And this is a graph that shows your divergence over price changes. So why would I possibly ever put money in? Why would I possibly put ETH in? Because what's happening is the liquidity pool is actually growing. So your 1% grows because on the other side, the trader is trading, and when they're trading, they're throwing in trading fees into the liquidity pool. And as the liquidity pool grows, your 1% grows. And so then when you do pull out, regardless of Ether going up or down, you can potentially, as long as the trading revenues exceed your divergence loss, you can pull money out. And so that's how you make money on Uniswap. You make money if there's trading activity, much as like how a market maker makes money. If there's no trading activity, they make no money, right? And so if there's significant trading activity in Uniswap, then those people that are providing liquidity are able to come divergence loss, right? They overcome divergence loss and collect their proportion of trading fees. Okay. Okay, so that's it, and I've got there's a bunch more on oracles and prediction markets. I'm going to kind of skip that. I just want to share with you guys some tools. You can go to Glassnode. There's a bunch of nice tools there. Yam Finance, some tools there I recommend. DeFi Pulse is a great website. This is like a year ago or 6-8 months ago. You can see the value locked is about $9.5 billion. And this is today about 27 billion locked in smart contracts. So great tool for that. There's DeFi Rate, also another great tool for you to kind of track what's happening in the DeFi space. Okay. Anna, are you there? Yep. Okay. So I did get a chance to cover the oracles piece, but I was going to cover Chainlink and Zap. And Zap is, a way to solve front running and a way to solve market making. Please check out Chainlink and Zap and the Zap protocol. So if you guys want to contact me, here's my contact information. Thank you, Anna, for this. Appreciate it. Thank you, guys.